Welcome back to Market on Close. With about 7 minutes into the bell, we're watching equities under a little bit of pressure again. But let's continue the conversation about 2024 and how some few big events reshaped our understanding of the year and our prep for next year. Collin Martin joins me alongside Mr. Kevin Gordon. Kevin's a senior investment strategist and Collin's director and fixed income strategist. Kevin, get us going here, because as we close out the year, equities are buckling after a pretty great 2024. How much of this was just kind of a little froth in your mind after the election? How much really is interest rate sensitive?
It's pretty much, I think, equal parts both, because if you do look at a lot of the froth heading into just the month alone, or in particular the Fed meeting for December, there were a lot of kind of stretched areas, both on the attitudinal and the behavioral side. And I think that's one thing that really, that latter category is really important, because even though there were a lot of surveys that were pointing towards excessive bullishness for a good chunk of this year, you really started to see it kick in terms of investor positioning in November. If you take equity ETF inflows on a rolling 4-week basis as a percentage of overall market cap, November was the most that we had seen in terms of inflows going back to since 2017. So you definitely got back into that excessively hot sentiment environment. And when you have any sort of negative catalyst that sort of surprises and jumps out at the market, it tends to tip stocks in the other direction. That's certainly what has happened recently. And then on the rate sensitive side, there has been a pretty remarkable deterioration in certain parts of the market from that standpoint. But I think as of now, it's not too much of a growth concern, I think, for the U.S. It seems to be a little bit of a global kind of ex-U.S. story where, materials and energy, for instance, in the S&P, those have been the weakest areas. That's, almost purely a commodity play and consistent with, things that are weakening around the world. And maybe even in the case of the U.S., maybe more idiosyncratic growth stories like home builders and residential and construction broadly. So I don't think it's as much of a worrisome signal yet. But if you started to see more of a deterioration in small caps and even breadth up the cap spectrum in the S&P, then I think it would be a little bit more concerning.
Okay. The bond market making a return to volatility, Collin. Also at the end of the year, it seemed like our old nemesis as equity investors was quiet throughout much of 2024. What in particular do you think awoke bonds here in this last month?
It really all comes down to expectations for Fed policy in 2025. If you look at what we saw over the past year, really, you saw this ebb and flow in long-term Treasury yields as expectations for the Fed terminal rate or how much they're going to cut in the years to come varied, where we saw yields initially pick up following a decline at the end of 2023. Then they came down again during the summer when we started to see some labor market weakness and the idea that inflation was coming down, only to see that reverse again over the past 2 months on the idea that labor market weakness has stalled and inflation is proving stickier than expected. So it really comes down to, how those two economic policies and outlooks play into the Fed going forward. And now we're seeing the 10-year Treasury yield, at the high end of its recent range on the idea that the Fed's going to cut rates less than expected next year. So as we look into 2025, it's really going to come down to the magnitude of those rate cuts should we get a few more.
Collin, thinking about the way the curve is steepening out, arguably one of my top stories of the year, a steepening that is combined long end going up in yield, the Fed's going down, the middle doing different things depending where you look, but mostly steepening. So how do we reconcile this with the history? Is there any precedent for this moment?
Well, you can sometimes point to the steepening of the yield curve or the uninversion as the idea that maybe there's a recession coming, because if it is driven more by falling short-term rates due to Fed policy, that could signal that they're cutting rates due to nefarious reasons. That's really not the case right now.
We got bear steepening.
Yeah, but we expect that steepening to continue, but we think it's going to be more of the bull steepening fashion. Because if you look at where T-bills are right now, 2-year Treasury, it's still very close to the Fed funds rate at the end of 2024. And assuming they cut 1 or 2 more times, we should see them continue to fall. As we look at the 10-year Treasury yield, we think they'll trade range-bound. They can move a little bit higher from here, but we think more of the movement's likely to come from falling short-term rates, probably closer to that 4% level versus the 10-year Treasury yield, say, rising to 5% or so.
Okay. It's quite a move right now. Kevin, I wonder if stocks care what form of steepening or if they just don't like certain nominal rates or rate of change, as you guys have also argued. Do you think equities care if it's bull or bear? Because I could argue till my breath is out that we should want bear steepening way more than bull, but I don't know if stocks are looking at that detail.
Yeah, I mean, I think the key is really going to be, and this is where it gets tricky, I think, for 25, and not just the calendar year, Jan 1 to December 31st, but really in this next part of the cycle, whether it's 6 months, whether it's 18 months. I think what's going to be tricky from an equity market perspective is finding this balance between, is the Fed holding back because now inflation is becoming a concern versus is the Fed going to then have to potentially go back into maybe more aggressive cutting mode because the labor market is a concern. And you still have, you're kind of in this not uncomfortable space, but potentially uncomfortable space from in a trend, and I would say lowercase s, emphasis on the lowercase s, stagflationary, trend, if that happens to be the case where you do for some reason get more labor market weakness in 25, but also a little bit of a firmer inflation backdrop. I don't think that's, catastrophic, but I think that's going to be the key is to sort of avoid, is for the equity market, is avoiding those really fat tails of inflation really getting out of the bag again, but then also the labor market weakening and then thus basically hamstringing the Fed and not allowing them to really move much either way. So that, I think, from a dynamic standpoint, in terms of direction, that is probably going to be a more key driver for the equity markets. I would say right now, it's probably more on the inflation side because you're starting to see that correlation between bond yields and stock prices turn negative again. So all else equal, every time you do get this rise in rates, it's putting downward pressure or is consistent with downward pressure on the stock market. And if I think, if we stay in that environment, that probably means that inflation, at least from a supply perspective, is becoming more of an issue again.
All right. I like that conversation, guys. Really good thoughts there. Appreciate you, gentlemen, and the commentary throughout the year. Always bringing the market session into a nice close there. Kevin Gordon and Collin Martin.